Welcome to the Enterprise Thought Leadership Podcast, where we explore the latest in enterprise trends, tech, and strategy with the top leaders shaping the future.
Hi, we welcome you to our podcast On Stage with Enterprise Thought Leaders. My name is Kanika and I'm the managing editor of TalkFintech, which is our enterprise fintech publication. We've engaged in conversations with global thought leaders and industry experts, reaching over 1.3 million business leaders worldwide. Credit rating has always carried significant weight in financial decision making, but they're often too little and too late. Major rating agencies typically adjust their views only after a company's fundamentals have deteriorated to a visible and often irreversible degree. This lag creates significant blind spots for investors, lenders, and counterparties who need to act before, not after the trouble strikes. That's starting to change though, since AI is now being used to detect early signals of financial distress well before traditional downgrades occur. Today, we're speaking with Rajiv Bhat. He's a CEO and co founder of martini.ai to discuss how AI is being used to fix the credit rating lag. Welcome to the podcast discussion, Rajiv. It's great to have you here with us today.
Thanks, Kanika, and loving being here. Very excited to be speaking with you.
It's a pleasure. So, the subject is very relevant for today and for these days nowadays, and we'll refer it to a real incident to prove that. Martini.ai is an AI native credit analytics platform used by lenders, investors, trade finance teams, and risk managers to assess and monitor the financial health of private and public companies. In January 2022, their system flagged an elevated risk for a therapeutics company, a full 13 months before the company filed for bankruptcy in February 23. That kind of early warning creates substantial competitive advantages for investors who can act on those signals. So, Rajiv, a little bit about him first. He's a co-founder and CEO of martini.ai, leader in AI-driven credit analytics. He was also co-founded a social commerce startup, Mercado, a Y Combinator W2010 through its acquisition by Groupon. Later, he led data science at AdTech unicorn InMobi. He holds a PhD in theoretical physics from University of Colorado at Boulder and an undergraduate degree from Indian Institute of IIT Kanpur. Welcome to the discussion, Rajiv. I think we've spoken accurate facts about you. Want to add something to it or about martini.ai?
Sure thing. No, that's all of that is absolutely makes sense. I think the one thing I would love to add there is just why we built this. Like a lot of people ask us, why do you get into credit? And we could be doing so many other things. And we felt that, look, the world's changing more than ever before. And this was about 5 years ago. And we felt the world's very connected. It's changing more than ever before. And we felt there's so much data coming up to the surface, both in terms of structured and unstructured data sets. And we felt machine learning AI had come of age. We felt this should be possible for us to know how things are changing. Like if there is a ripple in the fabric, what else gets impacted? And so, which is why we've been very excited, Rohit and I, my co-founder and I, to be building this out and like now seeing it in production. We're just very excited about it.
Great, good to know that, because we're going to ask for your expert opinion on how AI is being used to detect early signals of financial distress well before traditional downfalls and downgrades occur. So, please.
Absolutely. So when we first started on this problem, both Rohit and I, we have a fair bit of machine learning experience. We went and started building our usual models. And what we found is those models did not work very well because typically when you fit models, they kind of fit to the average. And when you're thinking of things like, is this company going to default? Is this company going to get into trouble? You're trying to find anomalies or outliers, and you're trying to say, hey, look, can I catch that early? And that doesn't work with a traditional model because traditional models fit to the average. And so we had to actually go back and then rework everything, build it up from scratch, kind of help that my co-founder Rohit, who did his PhD from MIT on knowledge graphs, had that background and like the work that he did on knowledge graphs won the Test of Time award, where you look at the impact your research has had on the field and recognize it after 10, 12 years. And so we built it up from scratch, and we kind of imagined this world where, every company is connected to hundreds of other companies. And we said, there is a lot of information that's present in companies that are around it. Like, if, let's say, our favorite example is, say, Carvana. If Carvana is struggling to sell cars online, then you kind of expect reasonably that other companies like which do similar things, like say CarMax and Car Gurus, will also struggle to sell cars online. So in the Indian context, if Zomato is struggling, you kind of expect Swiggy also to face some pressure. And so we said, how do we put that to bear? And so then we built this whole knowledge graph where every company is connected to 100 other companies. And then we said, okay, now we got to inform this graph. And so then we built, at that point, we did not know what's called, and now it's called grounding. And we built this technology where we can pull in all different kinds of market information. It can be, let's say, bankruptcies, or it can be bond prices, it can be loan prices, and whatever market intelligence is there, normalize it and put it into the graph. And use that to calibrate the graph. So we said, okay, now we have knowledge graph with entities, and those entities, we know where the risk is at. And then we developed a whole set of graph neural networks which kind of propagate the risk. So it's not very different from like, a stone dropping in the water, and you see the ripples and you're trying to see where it goes. And we put all of that together. It's fairly novel, like it's a different way of doing things. It's looking at stuff outside it. And what we found is that this, and of course, coming from machine learning backgrounds, we did a fair bit of backtesting and like to see if this works. We were very excited to see that works in terms of being, like the example that you mentioned, that seems to be quite the norm, because we do catch companies early. It turns out the quantity that we are predicting is a pretty well-behaved quantity, because we are trying to answer a simple question. Is this company getting better or worse? We're not trying to predict a stock price. We're not trying to do something too clever, but we're just trying to say, look, is it getting tougher or easier for this? And so we found in our tests that like we are on average, like, 6 to 8 months ahead of any other signal. Like we were in a test with a bank, looking at smaller private companies. They knew when those companies had defaulted, and we found that we were about 7 months ahead of their earliest signs. And it turns out your environment is a leading indicator. And I think also that turns out from a timing perspective, we were quite timely, because now things are changing faster than ever before. We find that on average, companies suffer like a fairly significant shift in their like margin structure, cost structure every 3 to 6 months because of some extraneous factor, something that they're not in control of. So it could be tariffs, it could be like a raw metal shortage, it could be like a competitor changing the game. And this is not something that you can catch with financials. Right? Like if you're looking at financials as a lender to make these decisions, which is great, you should do it. But those are going to be at least 6 months lagging, because if you think about it, let's say you're looking at an incident in Jan. By the time it gets captured in your financials, you'll see it in March. By the time the auditor has a go at it, you get it in May. And then you have to figure out, what does OPEX mean in that financial statement? What does all of those things you have to figure out. And by the time you do it, it's 6 months. But in our system, we provide credit updates every day. So we cover 3.5 million companies. For all of those companies, we provide daily probabilities of defaults, credit spreads, credit ratings every day. So helps people just be more on top of their portfolios super fast, and just react. And so they spend more time managing the risk as opposed to understanding the risk.
Right. You did mention tariffs, and that's a very interesting subject at this point in time. So, do you think the tool that you use would be able to assist and support investors in such a wildly changing environment as we have today? This is not a question I wrote in my list. It just occurred to me. So if you're okay, we can answer that, or otherwise it's up to you.
No, absolutely, Kanika. I think one of the more exciting tools that we've built is the scenario builder. And so we've spent a fair bit of time situating every company in this knowledge graph in the universe. And then we spent a fair bit of time kind of calibrating the risk of every company to many different things, and including its environment. And then on top of that, they've overlaid like this qualitative interface layer where you can actually talk to it. And we've been very proud of the way we've combined this quantitative, qualitative aspects of machine learning right now. So you can actually talk to it in free-form text. You can say, hey, what happens to this portfolio if blah happens? Like it could be any kind of scenario. It could be tariffs. It could be, let's say, a sudden climate change thing. And you get answers in seconds. And so I think that's the power of all the technology that's there right now and everything that's available right now. You don't have to be hostage anymore. You can kind of understand these situations very fast. So you can make quick decisions. You can change things. And also not just answer the question, what happens if, say, these tariffs come? What happens if these tariffs are revoked tomorrow? What happens if, like, in 3 days from now, something else happens? So then you can try out 20 scenarios. It takes you all of 20 minutes. And then you can figure out what stance your portfolio should adopt. Like, should it be more leaning towards a certain kind of commodity? Should it be doing something else? You can do all like a much more informed situation because much more informed decision making just because you've seen all the different scenarios and it's not expensive. Typically, for an portfolio manager, if they wanted to, right now, if they're not using Martini and they wanted to stress test a scenario, it would take them 4 weeks, 4 to 6 weeks, which kind of limits how many scenarios they can look at. But with Martini, they can do it in like, minutes, really.
So it's basically the agility of the system which can probably provide speed to decisions. That's what you're saying, right?
Absolutely. Absolutely. In fact, when we started around 2021, there was a very interesting incident where I'm sure you remember this, where there was a ship which was stuck in the Suez Canal.
Yeah,
I think it's
yeah,
the Evergreen or Evergiven,
yeah.
Evergreen. And it's incredible. Like, if you look at the pictures, it's fascinating that all that happened was a ship tilted like maybe a few feet and it got stuck. It was because it's so narrow and the ship was so big and made of, like, or maybe 10 or 20 feet and got stuck. And the ripple effects from that were incredible. Like, all the traffic got backed up, price of oil went through the roof, and all of these things happened. And at that point, there were no such tools. And you can imagine people wondering how this incident would impact their portfolios. And now we are, in a place where with Martini, you can just type that in and say, hey, what happens to my portfolio if a ship gets stuck in the Suez Canal? And it will answer that question for you. And so I just think it's fantastic to have these kind of tools in a fast-changing world and use the power of machine learning AI data to actually make sane decisions.
Fast changing and super unpredictable world.
Yeah.
So in your
Blows
knowledge,
on that, Kanika, the part that blows my mind is how fast, like how it keeps getting faster. It's almost like we are accelerating towards like complete like unpredictability. And it's incredible how like the cycles just get shorter and shorter and things change more and more dramatically. But somehow we still carry on, it's
yes,
fantastic.
there is a theory that after COVID, time has started moving faster. I don't know if it's one of those conspiracy theories, but it is. Everything seems to be moving much faster than it was before 2020. I
Yeah,
don't
yeah,
know.
more things are happening, right? I
Yeah.
remember like a time like 20, 30 years ago when nothing was moving. And now it's like you can't be accused of getting bored.
Yeah. I remember that as a happy time where we were not rushed for anything, but that's okay. Now the world has changed. So in your knowledge, was there an alarm system in place, Rajiv, before these tools came into place? Was there anything in place which could probably, warn investors or the industry about impending issues? Anything at all?
Couple of things, not in a structured way, but there were things like, the market prices, for example, and stock prices, like there's some signal there as stock prices start falling precipitously. Like, for example, if you think of Silicon Valley Bank, like the main risk signal there was in the stock price. It was not there anywhere else. And but there are some signals like that. I think for a lot of the public companies, there's some amount of coverage. People have a lot of money invested in those stocks, so they're particularly sensitive in terms of trying to understand the risks associated with that, their investments. And so because of that, there's some warning that comes in. But that's a very small part of the universe, right? Like we're talking about maybe 10 to 100,000 public companies, but like we have tens of millions of companies. So we cover 3.5 million companies. That's still a fraction of the number of companies that are out there. And so there's nothing there for the vast majority of companies. And that was in particular our focus area, which is to say, let's go into this opaque world, which is it's mostly consists of private companies, and see what we can do in terms of being able to provide some kind of clarity. And that's what we built out. So to answer your question on the public market side, there is something that's available by market information. It might not be very precise, but it's there. But on the private markets, there's nothing. There are ratings, and people provide snapshots, but those are not updated that often, and they're dependent on financials if available. Often their financials are not available. And so because of that, that makes a difficult problem even more difficult. And so I think what we built is novel in that regard.
So, just something comes to mind. These tools that you use for predicting economic or financial health, if I may call it that, how accurate are they? Do you have instances of being a little off the mark or way off the mark, or it is almost
So,
always accurate? What is your accuracy level there?
oh no, such a great question. So the way we measure the accuracy is we have a holdout set. Like, so this is a set of companies that the model has not trained on. So it's like out of sample testing. And then what we do is we look at the data and say, hey, 1 year out, did this company go get bankrupted or not? And so we actually measure the likelihood of it going bankrupt. And what we found is that 80% of the time, the bankruptcies happen in the worst 20% of our predictions, like worst 20% of our ratings. So and that's pretty good, because that's saying even for private companies that we can catch it uh, with a fair degree of confidence. And as always, like what we measure is like probability of default. By definition, it's probability. So we're not saying that it will default for sure or non-default, but what we're saying is quite likely to default. So if it is in the bottom 20% of the ratings, then we're saying, look, the chances of default are very high. And we find that 80% of the overall bankruptcies happen in that 20%, which I'm very happy with. And I think it's as good as it can get. I would be a little more skeptical if it got better than that, because then I would be like, maybe we are overfitting the data. But I like it. I think I'm quite happy with where that is.
Okay, great. So, my question was, what advantages will this deliver to enterprises? But I think the advantages largely come for investors. Am I right? But who stands to
Oh,
benefit from this kind of fairly accurate predictability of financial health?
such a great question. Two kinds of customers, two kinds of groups of users. Like you said, the first is investors. So these are people, could be banks doing commercial lending. These could be like, collateralized loan application managers, CLO managers, managing the huge credit portfolios. These could be big private credit asset management firms who are looking at portfolios which are in the thousands, if not tens of thousands of private companies. So if you're trying to monitor companies at this scale, a tool like ours is fantastic because you can do that instantly. And that's the obvious use case. The other use case, which is I find much more exciting as well and very powerful, is that for companies which are looking to manage their own risk. So every company, in effect, is a lender. Like everyone provides credit terms to their customers. Like if you think of an S&P 500 company, it has an accounts receivable portfolio in the billions, and they are doing business every day with tens of thousands of customers, and they're answering questions like, how much credit limit should I give this person? What should the payment terms should these guys be? Should it be 15, 30? And these decisions are very difficult, and they don't have a framework. And so we enable them to manage their business much more strongly. Like, for example, in the Sorrento example that you mentioned, Sorrento was a client of a customer of ours. And our customer was doing business with Sorrento, and Sorrento was growing rapidly, and they kept scaling up their business with them, and they kind of before they realized it, Sorrento was in trouble, and they lost $300,000. And that's pretty significant for a company. And so, in scenarios like that, we would be very useful, which is helping folks on the ground making decisions about their accounts receivables, trying to decide what the lending strategies should be. And so that's a second kind of use case. And you could explore further and find further use cases. For example, you can think of marketplaces trying to extend credit to companies for inventory management and things like that. So you could do a bunch of those things. But those are the use cases.
You may remember, I'm not sure you will, Morgan Stanley, when they came to India with their IPO, a whole lot of people invested in it. I did too. And in I think 2 years time, we were, below the buying price. So if we had any such tool at that point in time, we could have saved all that money at that point. Right.
Yeah,
So,
well, yeah.
So another question I had for you was, and this is actually two things I wanted to know, is the adoption of AI tools as martini.ai does for predicting financial distress. Does it also enable companies to course correct or provide any kind of solution going forward to maybe avert the bigger disasters, or any guidance of that sort?
Absolutely. I love your phrase AI tools. I think that's the right way to say it. This is not an oracle, right? Even Martini is saying, hey, this is our best estimate of the risk given all the information that there is out there. We are not saying that we put like a mark on it on this company and saying it will go down, but instead we're saying, looking at all the market indicators, looking at all the information out there, this is where we think it is. We kind of think of ourselves as a credit interpolation company. And in terms of usage of AI tools, I think we are entering an era where people want to have informed tools. It's not like earlier you had a clear segregation of companies of tools which would provide data or provide workflow optimization. So you'd either go to Excel for doing your work, or you go to some provider for getting news or getting signals. And now we are in a world where both of those come together. For example, if you're using ChatGPT to draft an essay on Mumbai, for example, and then ChatGPT will do two things at the same time. One, it'll find 5 things of interest to say of Mumbai, and 2, it will draft like a beautiful essay on those 5 things. And then you as a user will say, hey, look, so it's combined, like there's a data part of it, which is the 5 things of Mumbai, and there's a workflow part of it, which is actually writing the essay. And then you as a user will go back and be like, okay, you know what, of those 5 things, I like these 3. This 2 I don't like. Let's replace this with this. And you'll add one more of your own. And then you'll go look through the writing too, and you'll be like, hey, this is looking too pretentious. Let's tone this down. Let's avoid language like this. And it'll redraft everything for you. You'll go through that process, say 3-4 times. And then you'll get an essay which has your stamp on it. And you like it, and you think it's the right thing to talk about. And so you have it. So in this particular example, ChatGPT is like an informed tool which has 70-80% of the answer you want, and then you work with it to get to a point where it's what's needed to do the job. And so I feel Martini is like that too, that we help you get this, be able to operate in this world, get most of the decisions, even with a scenario builder. It gives you a first cut at what could happen, but then you can quickly change things around and see what happens. So I feel it's just a way to make use of all the information and data around you, and AI is fantastic for that. It doesn't take anything away from the decision making. So in that regard, I feel like these AI tools are very powerful and can help uh, uh, help you operate better in this world.
At least take better business decisions, maybe save yourself
Absolutely.
some money loss, some time loss,
Absolutely.
a whole bunch of
Absolutely.
losses. In fact,
Yeah.
I get that. So these were my questions. Is there something we missed asking you about it? Because it's a fairly radical, new kind of a thing that we heard about, which is why we wanted to speak with you. Is there something that I missed asking you? Would you like to tell us about it? Or have I covered all the
I think you covered the major points. I think it's like, I love the questions. I think they're very precise and to the point.
That's nice. That's good to know.
Thank you for joining us for the Enterprise Thought Leadership Podcast. Please do follow us on social media and subscribe for more ideas and insights. Until next time.